Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to look at Twitter. We're going to look at some information. I'm going to give you my financial opinions on what is being shared on there. Obviously, you guys can follow me at finding_finance. If you want to check out the website, it's finding-value.com. You can become a platinum member and join our community. So let's dive in here. Let's see what's going on news-wise. It says, Fed's bar to say the impact of SVB's failure appears to be widespread, threatening the entire banking system. Well, this is pretty big news. When you go and you look at a lot of the charts, let's come up and bring up a chart here real quick. Oh, there's my Finding Value website. Wrong one. So if you bring up a chart. We'll take a quick look at a couple of different banks. They look absolutely horrible. And I probably would agree that it is potentially widespread. So here is Credit Suisse, and this thing is just diving to the downside here. Lots of selling pressure. Let's get off logarithmic here. Lots of selling pressure there on Credit Suisse. Let's get the watermark back real quick. There it is, watermark, bam. USB, this is US Bank Corp. This is logarithmic, so that's logarithmic there. I tied the point here and point here, I ran it across, coming on up, and we are squeezing up into a corner. You can also notice 1, 2, 3 of a consolidation. And we've broken to the downside here, and it doesn't look that great. And Bank of America back on out of this thing. And I did show this yesterday too, briefly. This looks like a double top. We squeezed up into the corner, broke out of that thing, and then we're squeezing up into this corner, and it looks like we're maybe going to break out of this. Depends on the monthly and where this thing goes, but we might do a back test, retest breakdown, which could look pretty bad. So, yeah, I would agree. The impact of SVB failure appears to be widespread, threatening the entire banking system. It very well could be. And I don't know why they would say this. It's almost like they're trying to bring down the whole system. Maybe that's what their goal is. I don't know. Here's gold. So one of the ways to play this could be gold. This is the 4-hour 100 moving average coming up from below as we near conclusion of this decade-long basing process. So what he's talking about, this decade-long basing process, let's go to the bigger picture view. It started, 2012. We had a nice little shoulder, a nice big belly on this guy, and then another shoulder over here. You could also say that this is just one gigantic cup and handle pattern. The handle could be drawn this way. You can do it in all these different ways of drawing it. But if you zoom in on some of this, you have another basically, okay, that's a big picture view. Let's go this way, sorry. You also have another bottoming pattern here where this is 2022. This is the, quote, cup portion, another cup. And we've got an inverted shoulder head shoulder that is developing with a neckline where it's at in the green. And we could be coming fairly close to the conclusion of this pattern where we break to the upside and start to run. It is of no coincidence that gold is about to run as this banking system has problems, as those charts of the banks look pretty bad, and as yields start to roll over and turn down. And it may take, a few months. I'm not saying it's going to be immediate, but all of this is lining up for the conditions where gold could do some crazy stuff, and silver and platinum and all these different precious metals. I think UBS nails this here. It says oil prices have downside pressure due to mass liquidation by financial investors. Near-term oil prices to remain volatile. We retain a positive outlook. We expect rising Chinese crude imports and demand, plus lower Russian production, to tighten the oil market, lifting prices. So we've got these competing forces in the market right now. We've got downside mass liquidation by financial investors due to the fear in the market, due to these banks having problems. And here's the question though. I don't know, and I don't know if anyone knows what kind of pressure this will be and how long this will last. Could we create and let's pull up another one. I probably should have left that open. Could we create a more downside pressure with financial markets creating another, we'll call it another shoulder? So if we look at XOP, XOP is an ETF of the exploration production companies. And perhaps what we're doing is we're creating another shoulder over here where we get financial selling pressure into a shoulder here before we move on up. Now, I don't know if that's going to be the case. Maybe we just rip it right where we're at. But you can see the shoulder, head, shoulder that's inverted. That could potentially play out on that, or at least if you're viewing it on your right-hand shoulder. So there's that as well. But I do agree. I think they nailed this perfectly there. That's my opinion as well. It says funds dump copper amid financial market turbulence. Investment community has turned net short of CME copper for the first time in 5 months, while funds have cut their long exposure on the LME. This is another thing that ties in with the oil thing. It's liquidation by financial market turbulence, and financial players are liquidating the financial side. The actual supply-demand side, the fundamentals are incredibly tight in all of these commodity sectors. So it makes holding on to these things a real pain in the butt because you're getting all this volatility in the short term from market turbulence. The question I think a lot of people have is, how big is that turbulence going to get? And maybe they're creating it on purpose so the prices of these commodities don't go, rocketing higher. Difficult to say. And obviously, I don't know the answer to that. No one does. But that's the forces at play. We've got physical forces that are wanting to push prices higher, competing against the liquidity and the financial markets. They've got reasons to liquidate stuff during this, we'll call it the financial market turbulence. So there's the two pressures basically battling out against each other. Now here's another opinion here. It says hedge funds sold 1.5 times more barrels just in 2 weeks than the record SPR did in the entire year. The problem is when funds buy back their shorts, there will be no SPR to offset the buying pressure. So some of these guys think that there's going to be a whole bunch of buying pressure in oil, and there's nothing really to offset it. So we could see a lot of upside pressure in oil if these shorts were to cover their shorts. U.S. shale oil output growth expectations are being revised down as operators concede that upstream capacity constraints and shareholder demands for higher returns will limit production increases. Well, that's more fuel to the fire from the production supply side. Looking at the Fed funds rate here, it says the Fed funds rate expectations for December 2024 are now 2.8%. And so what I think the market's pricing in is a turnover here in, say, May or whatever, and we start to decline in the Fed funds rate and a decline in the 2-year yield. The 2-year yield, if we were to look at that, you can see that we got hit on the head here. We got knocked on the head here, and that's what caused this gigantic downward pressure move here. And I usually see that in a topping pattern. You get basically hit on the head, you get this large selling pressure move here, and then we're going to probably come back up to some extent, potentially. Obviously, I don't know for sure. And maybe we get a shoulder, head, shoulder pattern that forms eventually. Or if we were to look at the previous downturns here, once the 2-year yield basically turns, it doesn't really come back up. I mean, it came sideways here, but most of the time it basically just heads and turns lower for the most part. So if this 2-year were to turn and maybe it stays up a little bit and goes sideways or something like that, we can see that potentially this is signaling a problem in the market where we could turn lower. This is a perfect time to do a breakout and then a return move back to that potential breakout, doing a full retest type move. And then after that, we get a massive move to the upside. So that is a possibility. It looks like this is also in agreement. You can see the Fed funds rate, once it turns, it basically gets lowered to as low as it can go in a very quick fashion. It says a benchmark U.S. yield curve is headed for its steepest monthly increase since October 2008, and traders price in significant rate cuts. So this is the yield curve. And you can see the curve was massively inverted. We were going deeper and deeper and deeper and deeper all the way down here. And now the curve is starting to move back up. When you start to move back up, and I'd say once you pass this 0 mark, the majority of problems happen in the system. They all become very apparent to everyone. So what I like to do is I position in different assets when this starts to go up like this. I start looking to see protection. It's good to seek protection here, because when this yield curve starts to uninvert or starts to normalize and start to come up, that's when the problems will manifest themselves. The problems typically happen when they come above 0 here, like in March, when it comes down and uninverts and comes back up. That's 2022. We had a little scare there. This is a big one here from 2022 on, a massive inversion. So yeah, that's what we're seeing there, and we're going to have to watch this to see if it continues to, we'll say, uninvert or have an increase in the yield curve. Tavi says, meanwhile, used car prices increased again for the 5th month in a row. Prices continue to firm up at historical levels, despite being down about 2% on a year-over-year basis. Inflationary forces remain stubbornly high due to structural macro drivers. The Fed erased 5 months of QT in 2 weeks, and that should only add fuel to the inflation fire. So we had fear in the market. We've got these banks that look like dog crap, and now they are expanding that balance sheet. It is money coming into the system, and apparently used car prices are sniffing that out. So that's interesting. Buffett's buying even more Oxy. I guess Bison Interest isn't the only oil bull. It says Warren Buffett's Berkshire Hathaway filed for its purchase of 3.7 million more shares of Occidental at an average price of $59 per share. Berkshire now owns 211.7 million shares of Occidental plus 83.9 million warrants to purchase more shares of common stock. Here's Bonnie. It says, It concerns me the number of stocks making new highs has been falling since February on the NASDAQ and are not expanding. If there is no expansion and institutions stop buying large cap tech as an end of quarter window dressing pauses, a pullback in NASDAQ is likely. I agree. Now here is Uselink Casper. It says big time frame macro picture max target $15,000 on gold. Did the same type of move in the 1970s, 450%. Why can't it do something similar now? My base target for this decade is about $8,000, but it has been and it will be a wild decade on all fronts. So what he did is he's basically took this 675%, which is the lead-in move for this continuation pattern known as a cup and handle, and we're starting to break this to the upside. We are breaking it to the upside because the yield curve is rising. It's coming on up. The yield curve. As that comes on up, generally these are some interesting areas to be playing in during those time frames because of the market conditions. So what he did is he projected this guy on top of the breakout of the cup and handle where it would break, and it projects up to $15,120 for the price of gold. Nice looking chart there. Now here is silver. This is the big time frame macro picture. Long-term time frames with big movements requires a log scaled chart. Monetary reset times are here, silver to perform quite well. Triple digit silver is coming. So what he's got here is he's got the same basic pattern, but this pattern is the King Kong of all patterns. It's the largest cup and handle I've ever seen. It started in the 60s and 70s leading in. We've got the big cup finishing this formation in 2011. We came back down and we're starting to still come back up with this handle of the cup and handle. We also have, looks like even almost another cup and handle pattern that's smaller as well within it. So we've got a cup and handle within a cup and handle. The projected move, if you were to take it here to here, we get a silver price of $680 on a logarithmic scale. Is this right? I don't know. I wouldn't say it's wrong, and I wouldn't say it's right. I wouldn't say anything. I think it's a possibility. That's what I'll say. Patrick Karam says crude oil versus the SPX ratio following same roadmap as 1998 through 2001. Uncanny similarities. Who else is seeing this? So what this is crude oil versus the SPX. If you go back to the move of 99 back into the bottom of 2001-ish, we bottomed, then we broke out, and we really started to take off against the S&P 500. Crude oil did. We've got the same wave one formation forming here that we pulled on back. We haven't broken out of the wake-up line yet to the upside. This is still in a correction mode. But I do think that we'll break this to the upside just like we did in 2002. We'll break up to the upside, and then we go ballistic, Goose. We'll go ballistic. Now, one other thing that you want to notice. This is a logarithmic chart. We have a shoulder here, a head, and the shoulder is pulled all the way back to almost the bottom of this shoulder against S&P 500. So we do have an inverted head and shoulders. It's a massive pattern, and generally a good time to buy is in this general area right where we're at today. So that's oil, looking fantastic. I also posted U.S. equities as a whole are breaking down in slow motion versus gold right in front of our eyes. Majority of the crowd still massively asleep. So we look at this massive 9-year top structure. You can see kind of a shoulder, a head, and a shoulder perhaps. It doesn't have a neckline like that, so it's not technically that. But you've got a large, massive 9-year top structure. We've got an early breakdown line, and we've broken that line. We've done a retest, and we're starting to head lower, where gold is starting to outperform the S&P 500 or Wilshire 5000 priced in gold. So we're going to see an outperformance of gold. This ratio is going to go down. And what it's signaling is that this environment is different than the environment that we had from 2011 all the way up to just recently 2022, 2023. So get ready, guys. This is an entirely new decade with lots of different opportunities to invest in. Could the short term be very volatile, and could we get pulled down? Yes, we can. But overall, I do think that commodities will outperform as a whole over the next decade or so. And we're in a different environment with a paradigm shift of what assets will outperform. People are going to get scared out of stocks. People are going to get scared out of bonds. Interest rates may go lower in the short term and eventually go and move on up later. Obviously, I don't know that with 100% certainty, the direction of interest rates, but it looks like that to me, looking at the charts. But that's what I'm seeing in the charts, guys. That's what a lot of, some other people are seeing in their charts. A lot of them are ratio charts. Ratio charts I do like. They signal market conditions. They signal different environments quite well, and you can see that using technical analysis on different ratios of assets. So yeah, I think the paradigm shift is here. I think it is materializing. A lot of people see the short-term market movements. They get scared. They have the fear, and then they want to sell out of their commodity stocks or whatever commodities they're in. If you've chosen a pretty solid portfolio, I like the cash flow generators the most. I'm not nearly as scared as, say, maybe some of the speculative stuff that you can get a little bit more scared in. But that's what I'm seeing in the markets, guys, and there's a lot of opportunities out there. Gold looks really good, as we've seen with a lot of these charts in the beginning here. Oil, I'm still kind of indifferent in the short term. Don't know which direction it's going to go in the short term. Medium to long term, I think we're going higher, a lot higher, lot higher. But yeah, short term is always the hardest one to get nail right. And right now, gold's looking really good, short term, medium term, so to speak. And oil could look good. We'll see if the buyers come in here. We'll see if that short squeeze materializes. If so, I'm locked and loaded, ready to go. All right, guys, we'll catch you next time. This is Finding Value.